20 years old, you run a real estate business with $500 million worth of multifamily, and you dropped out of MIT. You're an anomaly.
Well, you know, I got started in real estate at a super young age. My parents kind of paved that path for me.
What gave you the balls to say, you know what, I'm going to drop out and go do this real estate thing?
My dad doesn't speak English. My mom speaks very little English, and yet they are very successful business people here. Everyone else, when they're like sleeping or going on vacation, my parents are working.
You're 20 years old, dude. This is some investment grade level shit.
Right, so we're able to close faster than other people, so we don't mess around. I hope something in the B's, honestly. If we don't get there, then, you know, something's wrong.
Welcome to No Vacancy, where I share conversations with LA's top multifamily owners, investors, and visionaries. I'm your host, Taylor Avakian, the founder of the Group CRE, and I specialize in the sale of apartment buildings in Los Angeles. On this show, we cut straight to what matters, market insights and real-world strategies straight from LA's multifamily icons to help you navigate one of the most complex real estate markets in the world, Southern California. Enjoy.
Zihao, welcome to the podcast. You're 20 years old. You run a real estate business with $500 million worth of multifamily, and you dropped out of MIT. You're an anomaly. So, tell me how that came to be.
Well, you know, I got started in real estate at a super young age. My parents kind of paved that path for me. So I got it started when I was like 13, 14 years old, just following the paths of my mom primarily. You know, my parents made their money in the fashion industry back in the 80s and then started investing in real estate in the early 2000s. Locally in Pasadena, multifamily, very focused, very, you know, one asset class and very deep into the nitty gritties of operations.
So how are they running a business and buying real estate? Was it like they would just invest in whole, slow growth, or give me do you know the intricacies of that?
Yeah, it was actually pretty active. So, you know, weekends is usually where the real estate comes in. And then, you know, when we started investing in real estate, the business was already pretty established. So it wasn't like a 9-to-5 job. It was more flexible for my parents. And so, you know, whenever they had the chance to see an opportunity or to see real estate or to do some operations, they always did it. We had property managers to help us along the way, of course. But yeah, I think they were just hustling, you know, more than other people, and was able to juggle two things at once.
Kind of that culture, right? Because your parents are both from China.
Yeah.
Born and raised in China.
Yeah, I was also born in China. I came here when I was like 6 years old.
Oh, really?
So pretty much raised in the U.S., but born in China.
Got it. Okay. And who was more interested in the real estate, your mom or your dad?
Definitely my mom.
Your mom?
Yeah.
Okay.
My mom likes kind of more stable assets, assets that she can see. My dad likes kind of volatile stuff. So he's really big into NVIDIA and Tesla and stuff like that. Yeah. So he's more into that kind of stuff. And my mom's more like the stable person.
So she goes for the real estate. Your dad goes for the stocks.
Yeah.
So tell me about, $500 million, your family's growing this up. You then are at a young age, 13, 14, brought in the business, taught a bunch of things. You're thrown into property management, all that stuff. And then you get into MIT. Walk me through the process of, one, how did you get into MIT? And then two, what gave you the balls to say, you know what, I'm going to drop out and go do this real estate thing the full time?
Yeah, well, getting into MIT is I took a very standard path, right? It's throughout middle school, throughout high school, I maintained really high GPAs. I think I scored a 1570 on the SAT as well. So scored really high on the SAT.
Yeah, which is at a 1600?
1600, yeah.
Okay.
Did a lot of math competitions and stuff. I was top 5% in the country in math or something like that. So did a lot of STEM stuff. Also played competitive tennis. I was 20 in the state of California, 90 in the country. So that definitely helped in terms of a little bit of recruiting, even though MIT is D3, right? So it doesn't just recruit you into the school, but it definitely gives you a leg up to prove accomplishment, right? So took a very standard path in trying to get in, still wrote a bunch of essays and, you know, had to apply normally, did Common App stuff and then all that application, and was really, I think at the end of the day, it's there are a lot of good students out there. It's, you know, sometimes it's lucky, you know, you just end up, you know, vibing with the people at the school and vibing with the school itself.
Yeah.
And so that was definitely lucky and definitely a big kind of accomplishment on my side. And then a year into it, you know, I've kind of built connections outside of like school and more in the real estate side before going into college as well.
How did you were doing that?
Well, a lot of it came down to like being active in the real estate space and then getting introduced to kind of my mom's friends, right?
Got
it's
it.
like, you know, usually when we do property tours, I'd follow along my parents, and then that like, you know, that intro comes naturally.
Got it.
But really kind of the decision to take some time off was when I was able to pull a Japanese investor onto my side. So we were always kind of under the impressions like, oh, you can graduate college and then come back to the family business,
Yeah.
right? Or you can graduate college, work for a little bit, and then come back, right? So it's always like this delay kind of approach. But when I pulled in that investor and he had enough conviction to kind of invest alongside my family, right? It wasn't like a 90-10 split at all, right? It was more like 50-50. But like even with that, it's like it made me feel a lot more confident in my abilities, and also made my parents feel a lot more confident in you know, making a career out of real estate, right?
Yeah.
And it's like we saw very little correlation between MIT and real estate. So we felt that, you know, we can actually just take some time off from school and try it out. You know, worst comes to worst, we go back to school,
Yeah.
right? And MIT is really good in that it's really an entrepreneurial driven school. So it doesn't limit you in any way. It's not like you take a gap year and you can never go back kind of thing. They actually encourage you to go back, like drop out and then go back if things don't
Wow.
work out. So I know Harvard gives you 10 years to finish the degree. I don't actually know how many years MIT gives you.
Wow. I mean, it sounds at this point in time, I don't think you're going to be going back anytime soon.
Well, I think, you know, if I stay within the real estate lane, I don't think I need to go back.
Yeah.
But if I want to like, you know, pivot into like real estate tech or something like that, something
Prop
tech
tech.
related, right? It's like then maybe going back and building some connections within the tech space would be helpful. I don't think I'll be the one doing the coding.
Yeah.
But definitely like making friends and building relationships.
The network there. Yeah, no, that's super important. So, man, your parents seemed very supportive of you coming and kind of taking this over and giving you that CEO role. Was that like, hey, you're going to come and be the CEO, and it's like, hey, it's a title, or hey, you're CEO now, step up. What gave them the confidence in giving you that responsibility?
Well, I think we saw it more as like a figure that has to do a lot of different things, right? Like a CEO is somebody who has to wear a lot of different hats,
Yeah.
right? So you see me like doing operations. You also see me like underwriting deals. And then you also see me like going to events and networking with people and trying to get investors, right? So our team is small, right? We're only 12 people, super lean team. So we didn't really like hire a specific person for a specific role. So I felt like I was able to, at least at our size right now, I'm able to juggle a lot of different things together and wear a lot of different hats. And so that's kind of where the role kind of came in. So for me, my day-to-day is not like, oh, just underwriting or just talking to investors. It's kind of a mix of both, right? Like you'll see me at NMHC at the end of the month, right? You'll see me at like the Laguna event at the end of the month as well. So it's like juggling different things and wearing different hats, really.
Got it, dude. That's incredible. So this investor, because you mentioned that being able to pull in a Japanese investor was a big catalyst for your parents giving you the opportunity to run this thing. Previously to that, was it all family money? Like you guys hadn't raised any outside funds?
Yeah. So even till now, we really haven't raised that much. We've partnered with him on a few deals. But kind of the issue right now for us is deal flow, right? So we have active cash sitting there, and we also have properties that we own without debt, right? So then because of that, the bottleneck is really on the deal flow side and not necessarily on the capital side. The investor was still important in giving them the conviction to pull me out.
Got it.
So yeah, that's kind of where we're at right now.
Because they saw a place where it would turn from a family run business to where it's a syndication model. Like they envisioned that, or there was an opportunity for you to then run a family business that could grow it instead of just having this slow family.
Yeah,
growth?
it was like they envisioned that it could grow into something much bigger than just our family.
Got it.
Right? If we just do our family, then it's like, you know, maybe we hit $1 billion and it's like a ceiling, right? And then you have to start selling properties and then refinancing and doing a bunch of other stuff to try to get liquidity. But they saw it as, you know, the potential to maybe put in 10% later on, right? As a real GP and put in 10% and
Got
really
it.
grow it into something much bigger.
Into a business instead of just kind of a storage of wealth. Obviously wealth creation, but it's a different business model.
Yeah.
Completely. How did you find the Japanese investor?
It was through an investment sales broker, actually.
Really?
Yeah. So the investment sales broker, he really liked me in the sense that he also had like a CS background, and he really liked supporting young people in the journey, right? Like I think usually when not just investment sales brokers, but also like lenders and like other like acquisitions people, when they see me, they usually like, they're a bit skeptical at first, but then, you know, after we talk and they actually think like I'm legit, right? It's like that becomes like a mentorship almost, right? So people actually really like helping me. I learned a lot from other people by talking to other people.
It's impressive. You're impressive.
Yeah. So in terms of like, that introduction, you know, an investment sales person was like, you know, their family is you know, well connected and also high net worth. You know, it's worth talking. But it wasn't like the first conversation, right? It was like we talked back when I was still in high school, and then we kind of kept in touch with each other, and then that turned into a partnership when I was in college.
Were you looking at deals while at school, trying to find the next acquisition for the family?
Yeah, when I was at school, it was much less because MIT is hard. But yeah, I always kept like kind of a pulse. My mom helped me out a lot as well. She like would send me stuff to look at, because sometimes, you know, I get email blasts from everybody, but like when I'm pretty busy, I just like click the red button and just leave. You know?
Exactly.
So, but you know, my mom's still very active, so she's like, you know, take a look at this. What do you think about this? You know, and then we'd like call like every single week and do something like
Got it.
discuss.
So you guys were constantly staying in touch and trying to figure out the opportunities, and then one thing led to the next, and it just kind of was a snowball effect from there. That's killer. Okay. And so I'm curious to know, like, what have you learned from your parents that you use in your day-to-day life? Like, what are some of the lessons that they've taught you?
I think like two things, right? One is like more of a philosophical and cultural standpoint, which is you always got to work really, really hard, right? They were immigrants coming into this country. My dad doesn't speak English. My mom speaks very little English, and yet they are very successful business people here. So, and it's because of hard work, right? It's like everyone else, when they're like sleeping or going on vacation, my parents are working, right? So like as a family, we haven't really traveled that much or taken that many like vacation days, you know? So we've always had this like, you know, work hard mentality. You know, we're foreign to this country, but if we work really, really hard, we can satisfy like the American dream, right? And be part of this culture and this new country. Yeah. So that's kind of more on the philosophical side. And then more on like the real estate side, I think is saving budget.
Tell me more about that.
Really, 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 really big on not overspending. We try our best to like literally cut costs down to the very, very like nitty gritty, and I try to extract as much value as possible. And this actually saved us on one of the projects we did in Pasadena.
Yeah, tell me, we were talking about that. What's the Pasadena story?
It was a 63 unit student housing to multifamily conversion. It was tough because it was during COVID and our, you know, many supplies were delayed. The electrical main panel just never came. Well, I mean, it came eventually, but like it took
18
forever.
months or something like that.
So what saved us was we decided to do a lot of things overseas, essentially buy a lot of materials overseas direct. Because my dad still lives in China, right? So he has a lot of connections there from like direct manufacturers.
Got it.
So we bought our cabinets overseas, saved us like 15-20%. Got the like blinds and the mini blinds overseas as well, saved us like it's usually around 15-20%.
Really,
each.
if you go direct.
If you go direct, yeah, and direct meaning like not in the U.S., right? Because usually like a lot of people like here they call themselves direct, but it's really not direct because they get it somewhere else in China.
They're not making it. Yeah,
exactly.
They're made in China.
Yeah, exactly.
So you're going direct to the factory that's literally making this stuff, or as close to it as possible.
Yeah, exactly.
Interesting.
So that saved us, you know, upwards of like $70,000 on the budget just from those two alone. So it helped us kind of you know, with the interest reserve and stuff like that in terms of cost and that project basically.
And so what happened during that process that made it like where was the issues, I guess, that happened besides the fact that the COVID was happening?
Yeah, I mean, so things were delayed, right? And then as materials didn't come, it was like we had the team ready. The GC was ready, but there's no materials.
So you couldn't rent it out.
Yeah,
Basically, it was vacant.
Yeah, it was vacant. It didn't even complete. We didn't get COO, right? So it was kind of a pause, basically. It was like mid-construction pause. And then so we were like, okay, so we have to figure something out where we can still pay our like debt, right? Because there's still debt. Debt never stops, right?
For sure. They're the mortgage company, the banks coming and saying, hey, where's our monthly payment?
Exactly.
Like, we need that
exactly.
thing.
Yeah. So we decided to try our best to save costs in other ways.
You mentioned to me previously other things that you've done to save some costs. Tell me about escrow fees, title fees. What are some other ways that you get creative with cutting costs?
Yeah, I think we just go line by line onto everything. Like the acquisition statement, we go line by line. Each month's monthly financials, we go line by line and wonder why like certain costs are the way it is, right? So like usually escrow companies charge like $2.50 for every 1,000 of the purchase price, right? With also like a base fee, right?
Yeah.
So we started like kind of shopping around and stuff like that, and then got it down to, it's actually under like $1. So we're in escrow on a 20-unit property in Whittier now, like $4.25 million, and it's like the escrow fee is gonna be like, they originally wanted to charge us like $10,000,
Yeah.
but we were like, okay, that's like, if you're charging us $10,000, we're going to a different escrow company, you know?
Yeah,
So we got it down to like 34. So it's like,
Geez, 70% off.
yeah.
65% off. Jesus. Okay. Yeah. Okay. So you're very diligent about cutting costs, and that's a theme. I'm a big proponent of studying great entrepreneurs, and that is a constant theme, as they're always nail detailed to the cent on all the expenses. You have to keep those as low as possible. So that was something your parents obviously were very big into from the beginning.
Yeah, and also I think it came from like kind of their fashion business, right? Like fashion is all about a margin business, right? Unless you're like Gucci and Louis Vuitton, right?
Yeah.
But everything else is like all about margins, right? So it's like my dad does the manufacturing for my mom here. So like how much is he making? Can we cut that lower? And then like the transportation fee from China here, like what's that gonna look like and stuff like that. So it was kind of ingrained in their blood to like when they started in the fashion business.
It seems to be your family's very vertically integrated in terms of the whole process, from beginning on the clothing side to obviously someone buying the clothes. On the real estate side, are you guys similar in terms of vertical integration?
Yeah, we're also pretty vertically integrated. So we have our own property management company. We obviously do the acquisition and everything ourselves. We're not yet integrated in terms of construction. So most of like the small value add stuff, we just let our team handle it, and we're like pretty vertically integrated that way. But like for big construction projects, we just don't have the deal volume to do that integration yet.
Yeah.
But we definitely believe in vertical integration, right? We believe if we can control everything and not let kind of other third-party vendors take a profit, then all that all that small stuff gathered together is a big factor in the profit.
Yeah, for sure. It's all making things from the background of the manufacturing, right? How do you make the most amount with what you have? How do you squeeze as much juice out of the orange as you possibly can, doing it morally in the right way, which it seems like you guys are doing. The deal that you guys are under contract, how do you find deals today, and how do you look at a deal and say, this is something that we want to go after?
95% or maybe 99%, I don't know, like majority of the deals that we find come from investment sales brokers. So we maintain good relationships with you and other brokers. And they typically show us a lot of good deals. Kind of our advantage is the balance sheet of the family, right? So we're able to close faster than other people. We're able to, show the proof of funds and show that we're, a solid buyer. And then also we don't mess around, right? Like during escrow, we won't like drop out of due diligence because of some stupid reason, right? It's like, unless we find something that's actually like impactful onto the property, we typically like, we're okay with it. And so we make the escrow process very smooth as well. The one in Whittier, it was listed at 495, I think.
So it was on the market.
It was on the market.
Okay.
Yeah. 495. We got it at 425. And then there was another offer that came in after us at like 4.4, but we felt it was like we put in our offer fast and stuff like that. It was right before Christmas as well.
How long was the property on the market before you guys tied it up?
I think it was like a month or two.
Really?
Like yeah.
And what did you see? Because that's typically a long time for, good deals don't last very long. So the fact that you're able to get a good deal, what did you see in the property that either excited you or saw a path to add value to it?
Well, I think like it was on the market for that long because the sellers were really tight on the price, right? So they weren't really flexible. They wanted kind of their 495 number. I just kind of threw an offer. My original offer was like 3.9. I was just like, whatever, just put my thing in and then just show it to them and stuff like that.
Yeah.
And I think that's really important. You gotta get the ball moving, right? Sometimes when it's listed a little bit too high, like other people don't want to put offers in, and so there's like no movement at all.
Yeah.
So I just threw something in, and then I was like, let's just get the ball rolling, see what they want, right? And then so they came down like 50,000, and I was like, okay, I'll go up like 100,000. Okay, let's just do this. Let's just keep on playing this, right?
Yeah.
And then eventually they did come. Like I think they were still at like the 4.6 mark, and then I was still in the low 4s, and I was just like, okay, like this is best and final, whatever, right? Either we take it or we're not gonna play with it, right?
Yeah.
And so they did end up taking it. And so that was what's interesting about that one is we got it at 212 a door, so a good basis, and then 5.3 cap, I think, on current, with like 5% vacancy, 40% expenses.
Yeah.
And then there was still around like 30% upside in the rents. So for that property, the business plan is to increase the rents at AB 1482 levels, just like 6-7% a year, right? So over like 5 years, we can get it to today's market rents, right? You get the 30% loss to lease in like 5 years, basically. So then after that, we plan on selling at like a 5.5 cap, and by then it's still like a value add project, right? Because it's like our rents are gonna grow, like inflation is gonna drive rents up anyways, right?
Yeah.
So like, it's still gonna have like some meat on the bone for the next person. And if anybody moves out during the middle, like any tenants move out, it's actually a good thing for us because instead of like the 6-7% increase, we go straight to market, maybe 20%,
So you're underwriting to today's rents. You're not forward projecting the rent growth, which is what a lot of people made mistakes in the past couple of years. They were underwriting projected rent growth, which is like, for example, let's say you think the rents are going to be $3,000 in 5 years and the current market's $2,650. You're underwriting to them being $3,000. You're going to get a certain amount of that. Whereas in this situation, you're underwriting in 5 years to get to $2,650.
Yeah.
Where you're not taking that risk out of the market. If the market rent grows, if it doesn't really matter because you have taken that into account.
Exactly. Yeah.
How do you look at, because obviously CS guy, math competition, are you really deep into the numbers? Is the data really important to you? And if so, like what data metrics do you care are the most important when you're looking at a deal?
Yeah, like I'm a big numbers guy, right? I typically look at all the units within like a rent roll, even like some bigger property, like 650 units in like Texas. I coded something that can basically tell me the intervals of different rent ranges. Like for example, like what percent of units are between like 1,300 and 1,400 and stuff like that. So I'm very big into the numbers because super numbers driven, right? I'm not like an emotional buyer by any chance. For me, it's like important factors are like cap rates, right? What am I going in? What am I exiting? And then also the stabilized return on cost, because that helps me understand is like whether I can hold the property without timing the market, right? So for example, that Whittier property, I can get it to like a 7.3 yield on cost, which means that like in 5 years, I don't necessarily have to sell the property, right? It's like I can hold on to it for another year or 2 or 3 at like 7% return, right? It's like totally fine. I'm like totally fine with that, right?
Yeah.
And then I'll get my IRR back when I actually sell, right? Because like you win on the buy and you also win on the sell. But the sale takes market timing and all of that, right? Everybody looked like a hero in like 2021, right? When they sold. So for me, it's like, what's the worst possible thing that can happen, right? How confident am I to hit that like 7% return on cost? And if the market, let's say, like crashes by then, right?
Yeah.
Can I still hold on to the property at 7% and pay the debt? And if the answer is yes, it's like, and I'm comfortable with it, and those like the projections make sense to me, then it's something that I typically really like to do.
So you have an A plan, a B plan, a C plan, a D plan. Like you have all of these situations where worst case scenario, I'm still fine.
Yeah, even in like worst case scenario of like rent control, like let's say something like Pasadena or like city of LA, like a 2, 3, 4% rent increase happens. This Whittier property has extra parking where we can build ADUs. So there's still a way to like extract value, even if the worst possible case happens. Of course, you're not going to hit your like 20% IRR if that happens, obviously. But like, for us, it's like worst case, we don't want to lose money. And we feel comfortable with it.
And you said you're not very emotional when it comes to real estate decisions. Does that mean if a deal in, Compton comes up and it's a slam dunk home run, makes sense, like you guys are investing there? Or do you have parameters in terms of either rent control laws or locations or tenant types, or is it going to be primarily Section 8? Like, is there a little bit of that in the decision-making process?
Yeah, like, so when I say like not emotional, I won't like say, oh, it's like a coastal property, right? And then I super like that. It's really hard for me to buy a coastal property. The numbers really don't make sense to me. But yeah, in terms of like rent control laws, right? Like that's a big factor for us, right? Because that influences the numbers. In terms of like, location wise, whether you're in like Compton or you're in like the best part of West Hollywood, right? That also influences us in terms of like collections, in terms of like how much work we have to put into the management side of things and stuff. So we definitely take those into consideration. But we won't be like, it's really hard for us to buy like coastal properties or mansions or anything like that.
Yeah, because just the numbers don't make sense. Clearly, you're numbers driven when it comes to making these kinds of decisions. You have a big, primarily the portfolios in like Pasadena and that area of Los Angeles. When the rent control laws shifted in those markets, how did that affect your portfolio, and how did you guys kind of overcome that or look to the future?
So we have 2 properties that are stuck, right? So one is on Madison Avenue, one's on Los Robles Avenue. Essentially, those, we only flipped half of the building. So the other half, they're stuck at the lower rents, right? So for those, what was supposed to be flip buildings becomes 10-year, 20-year holds, right? And we're okay with that in the sense that like we have liquidity. So we own it free and clear, right? It's like we can just wait for inflation to kind of boost it up, right? Basically.
Yeah.
But they were definitely like, they didn't follow the business plan, right? We were lucky in the sense that we move very, very fast, right? So once we get into the building, we don't like wait and chill out and stuff like that. We go in, the day after close of escrow and try to figure out what can we do. Right. So a lot of our Pasadena buildings are actually on market now. Like their rents are pretty high. And they typically give us good return on costs, like 8 to 9% return on costs typically. So we're just holding on to those. Obviously the sale value is impacted by the rent control. Even though they are at market, it's still impacted. But even with that, we're still comfortable holding on to those properties for a longer term.
So you have the flexibility to be able to, with the current structure, and then hopefully in the future, I guess it might change if you have investors, as long as they're aligned with your goals of saying, hey, if this business plan works out, we're going to hold on to it longer. If they're good with that, then you have a good backup business plan. I think where a lot of people get in trouble is they have the investors who either want their money back or they have certain timelines, like 3 years, I need my money back. Otherwise, there's going to be a problem. They're going to force a sale. It sounds like for you guys, you've never had the issue of needing to be forced to sell. Do you see yourself, if you continue to grow the syndication side, like how would you approach that?
I think I won't be able to play in the SoCal market as much with those investors, right? Like different investors want different things, right? So if you're somebody who wants like low regulations, right? You're definitely not playing here, right? You're going to play in Texas, right? You're going to play in the Carolinas. You're going to play in Florida, right? So for those, California wouldn't even be like a buy box for them, right? So even if I show them a deal and try to explain to them how it's like the most conservative city in the entire state, they still wouldn't take it, right? So for those, it'd be a different group of investors, right? So currently, most of kind of our family and also kind of our friends and investors are patient capital, and they understand kind of SoCal rent control, but they also understand the appreciation here, right? And the difficulty of really losing value on a good property here. So and they feel comfortable with that, right? But then there are also kind of the private equity funds, right? The ones that need to close out in 7 years, for example, right? And so for those, it's a different strategy, right? They don't have the flexibility to hold on for 20, 30 years. So they will be playing in like Texas, for example. That's why there's a lot more kind of the institutional guys in Texas than in Southern California. Right?
It seems like you guys have an institutional mindset in terms of the execution of the deals with the luxury of having the family office back end. So you kind of have best of both worlds. You're maximizing like you're a private equity company, but you have the requirements of more of a family office where you're not forced to do anything, which is, it seems to be, that's a great luxury.
And that's kind of our goal as well, right? Because like in terms of capital and AUM, we can't beat the institutions, right? No one can beat a pension fund or like Blackstone in AUM, right? Yeah. But their downside is kind of they're slow moving because they're too big, right? They're the 800-pound gorilla, right? So we're also not the mom and pop who doesn't really know what they're doing, right? So their downside is like something changes or maybe they're not as active, right? So we try to be in that kind of, we try to take the best of both worlds, essentially, right? We're trying to be well capitalized with the family, but we also take our jobs very seriously, right? So we try to take the best of both worlds and see where we can go from there.
So speaking of where you're going to go from there, I know you mentioned Florida and North Carolina. You have some properties. Are you exploring different markets? Are you looking at different markets? How are you determining what market you want to go into? Like, what does that look like for you?
So I want to go into like a less regulated state to try to kind of attract private equity money and also institutional money. So like I'm looking big into like Texas, for example, right? A lot of growth in Dallas, a lot of institutional capital still likes Dallas. Even though there's like the supply issues and all of that kind of stuff, kind of the issues everybody at the institutional level knows about. It's just like whether you get comfortable with that issue, right? So we're looking into Texas a lot. I've actually been looking for the past like 8 months now. I think at least for my comfort level, the prices are still a little bit high. I think we are seeing it come down, and there's a lot of like distressed properties as well. I actually just saw one from the lender today at around, they want to sell it around 50 to like 65K a door. Wow. In Dallas, which, at the height of the market in Dallas, like 170 a door.
Yeah.
Right? So it's like a huge discount. It's 60% vacant. So it's definitely distressed and everything like that. But I do see like a trajectory of potentially having a window of opportunity if we can be courageous enough to take on a distressed property and maybe partner with somebody local, right? And then still be boots on the ground. Like if we acquire in Dallas, I'm going to be moving there. That's basically how the strategy goes.
I was going to say, because one of the big mistakes a lot of people make is that boots on the ground presence. You almost need that to be able to execute at a level to know, okay, here's the amenities people like. Here's why this isn't a good property because of X, Y, and Z that occurs, or they're building something over here. You need that boots in the ground, especially if you're going to move quickly and not have these time delays that occur. So you really take that approach in wherever you invest. You need to have that, whether through a partner or you physically moving there to be boots in the ground. Yeah. That's what you're saying.
I think boots on the ground is super, super important in real estate. Being local, like literally walking every vacancy, walking every unit during due diligence, during the physical inspection, that's super important. You can't like, every property in every like kind of little sub-market or little pocket is a little bit different. So you can't expect to spend the same amount of money or on CapEx for like a turn, right? Like for California, maybe like 20 to 30K a turn. If you spend that in Texas, I think you're pretty much going to lose money for sure. So it's like more of a 5 to 10 maybe, 5 to 10K a turn, right? So it's like you have to like know your comps as well, right? So like by me being local there, if we acquire, then I need to understand who my competitors are in that little pocket and see if like am I like maybe my rents are low because of the unit turns aren't good, or maybe is it my leasing team is not good, right? So I need to be able to figure those things out and adjust appropriately in order to make a profit later on.
Yeah. I mean, gee, you're 20 years old, dude. This is some investment grade level shit. Some of the conversations I have with investors who own a ton of property in Los Angeles are not as sophisticated as this. So I'm very impressed from that perspective. What do you look for when you're going and touring these units? Like when you're doing an inspection, what are you looking for to determine, okay, this deal makes sense?
So I go in, depending on the vintage of the property, I go in with an expectation, right? It's like if it's a 60s property, I know kind of what it looks like, right? Like popcorn ceiling, right? Like broken wall heaters and stuff like that. Old cabinets. If it's like a maybe an 80s building, maybe a little bit newer. But a couple of things like, one is like parking ratio, right? I don't want less than a 1-to-1 parking ratio at least, right? So that's important to me. Yeah, the condition of the unit is less so important to me because I'm going to spend CapEx dollars anyways. And I don't really trust the CapEx that the previous seller put in anyways. So like I kind of just ignore that. Obviously, like kind of the panels and stuff for insurance purposes is also important. Fire extinguishers, carbon monoxide and stuff like that. But overall, I think one thing that maybe others don't look out for, but it's important to me is like the tenant profile. Right. It's like who are the tenants in there? Are they like, maybe elderly and what are the chances of them moving out and turning over and stuff like that? I need to have a gauge of who I'm dealing with and what kind of whether my business plan is feasible. Right.
Yeah. So it seems like you have pretty strong assumptions, or you make strong assumptions prior to acquiring a building, and then you're there to either prove them right or prove them wrong.
Yeah. So typically, like during the underwriting, we determine the business plan, right? That's how that's how you underwrite, right? Whether we're re-tenanting the entire property or we're just doing the AB 1482 increases, right? So that's the business plans that we have to make decisions on, right? And we have to verify the possibility of execution during the inspection, right? So if we're trying to do a whole re-tenanting program and for that specific property, and then we go in and realize it's probably not feasible to do that, then we have to reconsider whether this property is actually gonna whether this business plan fits this property, right?
Got it.
Yeah.
Are you typically, when you make the assumption on the business plan and it changes, right? You realize that business plan doesn't align. Does that immediately make you say, I don't want to do the deal? Or are you looking at it from what can we do, a different business plan that still may make sense? Do you have different business plans for different outcomes?
Yeah. So maybe a property the re-tenanting doesn't work, but the rents aren't that low, right?
Yeah.
So maybe there's a different strategy, or maybe there's a lot of courtyard space, right? And that means ADUs, right? We're pretty good at building ADUs, so we try to, maybe there's a lot of garages, right? Maybe there's an extra laundry room, right? And sometimes things exceed our assumptions as well, right? Maybe when I was underwriting, I didn't realize that there was this huge laundry room and another one right behind it or something like that, right? And then so maybe that is a signal to us that we should either put in more equity or get a different type of loan to try to build ADUs and stuff like that. So, maybe our loan assumptions originally were 65% loan to value is not the best option. Maybe we should get a little bit more dollars and at a higher interest rate or something like that, do a bridge program or something like that. So yeah, it's definitely to verify the business plan and verify our assumptions.
You mentioned parking. Why is parking so important to you?
I've had a really bad experience leasing units without parking.
Okay.
Even studios. So studios, 1 bedrooms, I like to have at least 1 parking. And then 2 bedrooms, typically I like to have 2 parking spaces. I won't give the second out for free. I charge $150 a month, but I'd like to have that availability. Right. So
you were scarred, basically.
Yes. It's very, very difficult to lease without parking, especially when the property is on a big street, right? If it's on a big street where there's no available parking, then where exactly are they going to park, right? You have to kind of put yourself in the tenant's shoes, right? It's if I was a tenant renting here and I realized there's no parking and there's no good public transportation around and I'm not a biker, then it's going to drive me away, right? Or at the worst case, maybe I'll still live there, but at lower rent, right? So maybe my rent assumptions will change because of the parking issues.
And it's hard to calculate what those assumptions are. So speaking of parking, it seems like California and a lot of the country is going towards parking-less buildings, ED1. There's a lot of affordable Waymo, like all this stuff. The city's encouraging you not to build parking with it is. Do you think that makes sense? Do you think that there's a future where that becomes the norm of people not having cars, or like how are you looking at the future of where we're headed?
I don't know if it's the city not wanting you to build parking or the city just wants you to do more density, right? Because like California has affordability and supply and demand issues. So I think that's kind of the big push, right? Like ED1, I think it's not that they don't want parking. It's like they need the density, right? And they need the expedited plans and everything like that. So I mean, I understand where they're coming from.
Yeah.
But for me, I've never invested in like an ED1 project. I think that business model is still very new and has yet to be proven, right? It's like, how long has it been here for? Is like not that many, right?
Like
so
less than a year.
Yeah, we haven't really seen lease up or sale and stuff like that, right?
Yeah.
So it's still yet to be proven how successful that might be. So I mean, if that proves to be super successful, maybe my perspective will change. But right now we're staying a little bit more conservative in terms of parking.
What do you think the future is of real estate, of technology, of AI, and how it is entwined in commercial real estate? Because we talked about this a little bit, you being a computer science major and me being a geek with AI, about kind of some of the possibilities of being able to implement it, and then where this technology is going from an underwriting perspective, from an analysis, a market analysis, a deal analysis. Like, where do you see the future of prop tech, of AI, and that affecting investments?
I think like the big elephant in the room is whether like brokers will still be here, right? I think at least for like the near future, I think brokers are still very necessary. I do think like AI and tech is going to impact their workflow by making it easier for them. And maybe they can cover more markets and get more listings and stuff like that. But I think it's still important to have brokers because it's a big transaction. You know, it's not like it's a $20 thing or $30 thing, right? It's like many millions of dollars, you know, and people really like at that scale of money, people want a trustworthy person, right? It becomes an art more than like a science. And so for that, it's like, you know, I trust Taylor. You know, I know he's a trustworthy guy. He's sold buildings around this building before. You know, I know he knows his numbers. And because of that, I want him to represent me because I think he's going to, you know, he's knowledge enough to put my interests, you know, above others, right? So it's like, because of that, I think, you know, maybe you don't need to create OMs anymore. Maybe you don't need to send emails anymore. But I think by having you on my side and talking with me and like walking me through the numbers and the assumptions, it makes me feel more comfortable.
Okay, that's interesting because as someone as detail oriented as you, like, I feel like if you had to sell your building, you know enough about the property itself and being able to sell it, and especially with all these third-party tools, LoopNet, CoStar, right? You pretty much probably could sell your building if you wanted to. What's interesting and what as a broker I've experienced and thought about, and you mentioned this earlier, is 99% of the deals you get are from brokers. And so it's going to be interesting to see if that ratio changes, and that if principals have the ability with AI to sell properties themselves. Because I think a lot of the reason that brokers are so involved is because we sell buildings to people, and it's kind of this reciprocity nature, right? If you're going to send me deals, you're going to give me good deals, like I'm going to return the favor to you by letting you list and sell this property when I likely probably could sell it myself if I put it on the market or marketed it, and maybe the commission offsets itself and maybe it doesn't. Who knows? It's hard to track exactly what that ratio is, but do you see a world where that happens, where it's more principal to principal and the broker maybe they're not as responsible for getting you deals?
Well, I think it's like, I think there's two things to that, right? So like the first one is, even though I know what price I want to sell at and what price I should be maybe buying a property at, I don't actually want to do the negotiations and picking up like 12 different buyers' calls every day and answering all their due diligence questions and all of that kind of stuff. So there's still like for me, I like, my job is not like to do that. So like I have other things I need to do, right? So it's like from that perspective, I think it's still important to have somebody to do at least the negotiations for me, right?
Even if it's $200,000 worth of negotiations?
Well, it depends, right? It depends on the number, obviously, right? But like even like stuff like that, right? It's like negotiating. I don't really want to be the bad person, almost like the broker sometimes is like the bad person, right?
Yeah.
It's like you have 12 buyers lined up, one of them gets it, and then you have to hear sour things from the other 11, right? So it's like I don't really kind of want to do that, right? And the second thing is I think adoption, right? It's like it's super relational business, like relationship driven business, right? So who's going to take the first step to say, I'm going to break all my broker relationships and basically do this thing myself, right? And then maybe if this takes off, I become a hero. If this doesn't take off, I might as well just never do real estate again.
Yeah.
Right?
Or I got to go to a different market and completely shift the business model.
Yeah, exactly. Right. So it's like the adoption phase, I think is difficult as well. Right. So, but I who knows, right? I like 5 years ago, if you told me about ChatGPT, I wouldn't have believed you either. Right. So it's like the pace of how technology changes and stuff like that is like, it's yet to be seen in the future,
How are you using AI in the current business, and how do you plan to want to use it in the future?
Yeah, I use ChatGPT every single day to research about a property. Like Google, I feel is a little bit outdated now with like ChatGPT.
Yeah.
So like I don't really I try my best to not like use Google if I need like a direct answer, right? If I just want to do research, maybe I use Google. But if I need like an answer quickly, then I just use ChatGPT. And then also I think one thing that's super impressive is like maybe it's better with Claude, but it's like it's PDF to like Excel. We got like transformation thing, right? It's like because a lot of like people send me like rent rolls and T12s on PDFs, and I'm like, what do you expect me to do with that, right?
Yeah.
It's like can you send me an Excel version? But now I can just put it in, and then it transforms it for me, and it's very, very convenient. So yes, like stuff like that. And then also like one thing that's also kind of important to me is like the rent rolls. Like if there are different line items per unit, right? Like for example, like the rent, like maybe like a HUD subsidy, and then like parking and like a lot of different items. I need it in like columns, right? Or else I can't do my calculations if it's all in rows, right? So it's like manipulating Excel and stuff like that.
Got it. So you're using it to streamline your workflow and being able to underwrite quicker and be more accurate with the assumptions and things like that. Because and that's interesting too, because if parking they're charging $100, but you think you can charge 125, like there's delta there, there's opportunity there, and 25% of it to be exact. So that's super interesting. Where do you think the future comes in terms of? Because this fascinates me because there's so many pain points that I have in my job. Right, so many pain points, and I'm a hardworking, lazy person. I want to do the least amount of work for the most amount of bang in my buck. That's how naturally I am. And what happens is I'm not that smart, so then I end up working way more just to make up for the fact of that. But there's things where I'm like, so for example, I saw this program, and I think it works for houses right now, and maybe eventually for apartments. But it's a camera. It's an AI program system where you can take your phone and it scans the property, and it can basically make assumptions on the renovation costs and what's it gonna cost to actually get this thing fixed up. Or the roof, maybe you can't see the roof, but you send a drone up there, and then it estimates based upon the visual. The AI system sees the image and then can make assumptions based upon that. Do you see yourself or you guys being on the cutting edge of wanting to implement some of those technologies, or how are you thinking about specifically from getting as much juice out of the deal as possible?
I think for us, it really depends on how impactful the technology is for us, right? It's like the service you were talking about where you're able to like take a picture of the unit and then get a renovation budget. For us, it's less important because we kind of know the renovation budget, right? That's kind of our job, right? And then also during inspection, we can bring a contractor in, right? And they want the business, so they're very happy to do it for free, right? So it's like, for that specific tool, I think it's harder for us to adopt.
Yeah.
But I mean, I think for other tools that are maybe a little bit more impactful, then it's like super, like I'll be the first one to sign up.
Yeah. You're going to be testing it out.
Yeah.
If you had to start over today, right? You were fortunate enough to have your parents teach you and legacy and have some properties to then be able to negotiate and go sit in a room with a Japanese investor and say, hey, look what we've done. I'm smart too, and I can stand up for it. But if you had to start today from scratch, zero, right?
At my age or?
Yeah, you could be your age, right? But you have your knowledge. You have your knowledge. How would you start today? Because I know there's a lot of people watching this who want to be principals, who want to get into business. And they just don't know. They're hearing all these things. LA's tough, regulations, Texas is hot. Like, how would you go about starting from zero and building up to what you guys want to become?
I think I'm super lucky on multiple fronts, right? It's like one is I got started early, right? Like my parents had the vision of just doing it, right? And then also I'm very fortunate in that like they trust me with their money, right? So I didn't start with nothing and empty-handed. So I think I'm very fortunate in that way.
Yeah.
It'd be a lot harder to close to impossible if I didn't have like at least the capital side of things. Maybe I can still learn the knowledge myself and asking people, but like the capital side of things, if I didn't have that, I think it'd be very difficult. Which is why I think possibly the best way is to be like a investment sales broker. You start off getting to know people, right? Like as a broker, you get to know the owners, but you also get to know the real principals, right? The people that are buying the properties, right? And then maybe you start by rolling your fees in, right? It's like, live tight for the first couple of years and roll those commissions in. And then when you get to relist the building, roll that in again, and then start building equity. So that's like it's basically sweat equity, right? You're working for the equity, right?
Yes.
So that's probably the way I take it. Just because I think real estate is high barriers to entry, right? Without a big balance sheet and like a loan guarantee and all of that kind of stuff, it's hard to get started, right? But that's possibly a way to like build relationships and get started and start building the portfolio.
100%. And I couldn't agree with you more. And I think it's a great way for people to get exposed to it and meet the right people. That was advice that I got when wanting to get into real estate. I wanted to be a developer, and a mentor of mine said, well, go be a broker first and go meet the people, go understand what a deal is, a good deal. Who is involved in every step of the way, from title to escrow to lending to insurance to assessors. Like there's so many nuances to it that you have to kind of understand first before you're going to go use your own money or someone else's money,
right.
For that fact. Given, let's say you have your skills, you're a broker, you're a couple years in, and you want to go raise capital. You are in that stage of now seeming like going to try to find investors and raise money. How are you approaching raising money, and what do you think is like separating you, or how are you thinking about the business plan of raising capital to grow the portfolio?
I think it's a trust business, right? It's like, I'm not going to give you money because you're that, like, I think in real estate, it's really hard to be that much better than somebody else, right? It's not like tech where it's like, okay, I just know how to code faster than you, you know? It's more like everybody kind of knows how to do the value add, and everybody kind of knows how to do development. Maybe it's like they're more specialized in a specific pocket of like a submarket or like a specific city. But I think everybody's level is kind of the same, right? So it's like, it's building a relationship, building trust, and building your integrity as well in front of others, right? So I'm lucky in the sense that like I can have more skin in the game, so people trust that, right? It's like, okay, you're putting 50% of the capital, I'm putting 50% of the capital. If we die, then we die together, right? So it's a little bit different kind of scenario. But if it was like a 90-10, or like a 95-5, that'd be a lot tougher, and you'd have to build like a track record for it. And it's hard to build that track record because it's like, let's say you save up all your money, right? And you buy a 5-unit property, right? It like when you want to buy a 100-unit property, it's like, that's not really a track record anymore, right? So it's really hard to do that. So like, again, super fortunate to have the ability to do that. But I think, building trust and talking to people and constantly like putting yourself in front of them, right? Presenting yourself as a reliable person in front of them is super important.
Where do you go to find them? Where do you go to find investors?
I do a lot of events, right? So like I like NMHC. There's like BEC Best Ever. There's like a lot of IMNs as well. Recently I've started to like speak at some of these events. And referrals as well. If you start, like if you get your first investor and then your second one, then I think magically it starts multiplying because people talk to one another, and the more active people, they all know each other, right? So, and for me, I think it's also important to be like special in some way, right? Like something that stands you like out, right, from the rest of the crowd, right? And for me, it's like my age, right? It's very, very, very super obvious.
Yeah, why is this
right?
young guy speaking on a panel?
Yeah, exactly. So it's super obvious, like kind of my standout point.
Yeah.
But maybe for somebody else, it's their story, right? Or it's their specific market that they play in, right? Or their specific strategy. So it's finding that niche that you have or that standout point that you have and really conveying that to other people.
That's super interesting. That's so cool that the self-awareness that you have of leveraging, because a lot of people think, especially in brokerage, but even in investing, like my age it's a negative thing, right? But you've been able to flip that on its head, and that's your standout is like, wait, this kid is super successful in terms of, sure, he had this portfolio, but like he's grown it. He's super smart when he talks about the numbers, his business plan, like you're rock solid when it comes to, well, if this happens and this and this and this, you can speak the game and you're very confident in knowing that, right? And so then your age becomes a competitive advantage because then you become almost like a whiz kid. They're like, wait, this is the next Elon Musk of real estate. Like I got to invest in this guy, right? Because it says something about you. It says something about you that you're in a capable position mentally and your track record is there where it's like, I'm at the level, if not above, what everyone else is going to be. Get on the train because I'm taking it to the moon, right? I think there's that level of opportunity that people see, and maybe they see a little bit of themselves in you too, right? Where they were like, shoot, he's doing it, like he's doing the thing, which is pretty incredible. I want to talk a little bit about some metrics that other investors ignore. And we talked a little bit about parking and things like that, but what are some other metrics and deal points that are something that you think you spend an inordinate amount of time or that other investors should spend more time in? And it could be deal level or it could be market level.
I think, everybody kind of pays attention to the big ones, right? Like the ones that they see, right? Like interest rates, people pay attention to, price per door, they pay attention to. I don't know how many people pay attention to like price per foot. I think that's important to me, right? It's like, because that tells me whether it's like all studios or like something like that, right?
Yeah.
Or if it's like all 3 bedrooms, right? So I pay attention to price per foot because I got into the habit of ignoring it a few years ago. And I think that's not really good, especially on the exit. Because if you buy one like that are all like 1 bedrooms or all studios, the exit no longer makes sense at like, $700 a foot in like, city LA. I don't know, like whatever market, right? But like a super high price per square foot, right?
Will you explain that? Because I understand what that means, but I don't think a lot of people understand why that like replacement cost and what that exit, break that down a little bit for people.
Yeah, so like typically smaller bedrooms equals more turnover, right? Because it's like typically maybe a single person living in there, or maybe like they boyfriend, girlfriend, and then now they have like a kid, now they want a bigger room or something like that, right? So more bedrooms typically is like family style, so more stability. So more bedrooms obviously is like bigger units, right? So like the price per square foot, when you divide like the purchase price by the total rentable square feet, is like a lower number if you have bigger units and a higher number if you have smaller units, right? And so for us, we also got to take a look at like, okay, if it's an all studio, all 1 bedroom unit, should we factor in a higher vacancy because there's a higher likely of turnover? And should we like maybe put more money into like turnover costs because maybe it turns over like twice in 2 years instead of like maybe once in 2 years, right? So it's like a lot of assumptions come into that unit mix side of things, and then also the price per foot, right? The price per foot is just like an indication of the unit mix. Of course, like don't ignore the unit mix. That's like the most important thing ever, right? But like, when you're taking a look at the price per foot, also try to understand if you're overpaying on that side of like that spectrum, right? Because typically like lower price per door is higher price per square foot, right? Because you got to offset that like bad unit mix, right? So, when you're looking at a property, look at obviously the per door because it's like the first number you look at, and then also like the per foot, like the cap rate. Oh, and also like how they calculate the cap rate. That's important. Like typically 40%, like 35 to 40% expenses, right? Don't put like a 20% expenses and tell yourself it's like a 10 cap, right? Because it's not. Like be reasonable on that side of things. But I think overall, if you just be reasonable and really try to justify whether your assumptions make sense, I think you'll be good.
I think price per pound. So from an investment perspective of the deals that I would feel most confident in investing is low price per pound, because you can't replace a basis. You know, like if you buy a building at 200 a foot and 200 a door, like that's your basis. If you buy it at 200 a door and 350 a foot, that's your basis. And the way that I look into it from an investing perspective is just exactly what you said, is from an exit, right? So if I have to put in $50,000 per unit, which then, puts another $75 a square foot on the building, is it possible that I think the building can sell at $500 a foot and $250 a door? Is there anything in the market that would prove that is a possibility in my business plan? And if I'm at the top of the market of my exit price, I'm setting the record, I don't feel very confident in that business plan, right? I want to be, if I execute my business plan to the perfect level, I'm still below what the craziest price per square foot and the price per unit is sold, because you just get that buffer of safety and knowing that someone else, like the greater fool theory, right? Someone else has justified being able to pay this amount of money, and the cap rate and the income and GRM and all that stuff matters from that perspective too. Not just basis, but like if you have a $1,000 a square foot building and it's 7 cap, like it doesn't even matter, because people just are like, it just build it over again. And it's a very weird thing, but basis is huge for me, which sounds like it is.
Basis is important. I look less so at the replacement cost though, just because like I deal with older properties, right? I typically deal with like 60s, 80s constructed properties. So it's like the replacement cost to build like a 2025, constructed property is going to be different, right? I'm not going to be building an old building, right? I don't think it's possible to do that anyways. So I look less at the replacement cost, but I definitely do look at comps, right? I don't want to buy at the highest price per door or price per foot. And I definitely don't want to like sell at the highest price per foot or price per door, right?
Yeah. So even if you can get to an 8% yield on cost, but you're way above the comps at that stabilized value, that to you is kind of a red flag.
Yeah. So I try to break out like my returns, how much of it is because of like the cash flow I'm getting and how much of it is because of the exit, right? So we run sensitivity analysis, right? So it's like, if my entire business plan is like you get a 20% return because of the exit, that doesn't make me that comfortable, because that equals market timing, right? And so I want to try to balance out. It's like, okay, like I have cash flow that's causing some of the like maybe the 20% returns, maybe 10% of the that returns is from the cash flow, right? And then maybe well, it's going to be less than 10, but like let's say like 8% of the IRR is from the cash flows, right? And then maybe 12% of the IRR is from the exit, right? That makes me feel a little bit more comfortable than if it was the other way around, right? And so because of that, it's like we break out and run sensitivities to really understand is like what's driving that return.
How many pages is your Excel spreadsheet?
7 or 8.
Okay.
Yeah, not that bad.
Okay, that's surprising. Yeah. I know. And are you? I'm just curious. Do you have to use your mouse, or
no.
You don't use your mouse?
No.
You just use the keyboard.
Yeah.
I hope to be you one day, man. Seriously, that's so.
I think you got to play a lot of Excel games. There's some games out there that are like actually pretty fun, you know?
Dude, okay. I got to gamify it. That's what I got to do. I got to make it a competition and like I'm going to look up after this some Excel spreadsheet games and get really good at keyboard shortcuts and all that stuff. Cause it's just badass when you see someone who doesn't touch the mouse and you're like, it's kind of a flex, man. Like, it's like you see a buff guy, like guys care about how big you are when the girl doesn't really care. It's the same thing. I'm like, oh, dude, that's sick. It's so dope. A couple things before we wrap up. What surprised you most about being a CEO in terms of like challenges and learnings and putting yourself in this position at such a young age?
I think managing people. It's hard to manage people when they're like probably twice your age, right? And like most of my team is like basically twice my age. They all like so kind of the lesson I learned is I really need to know what I'm doing, right? It's like because everybody's kind of lazy, so if they don't have to do something, they try not to tell you, or they like just kind of say yes and then kind of put it off a little bit. But that influences profit, right? So for me, it's like, because I kind of went through everything, right? The property management side of things. I posted my own like eviction notices. I was with the property manager and we were in court to do evictions and stuff like that. So I went through like a lot of things, right? So because of that, I kind of know if I like make this move, what's the most likely thing that the tenant's going to respond with and how I should prep that basically. So that helps me like, so I'm not really like a manager in that sense. I'm more like a guide, right? And somebody's just helping me do the execution and I'm just like guiding him on what to do, right? So that's important at like my age and my level. It's like I can't go and yell at everybody, right? That doesn't work when somebody's so much older than you, right? But what I can do is try to anticipate what's the response going to be, and then try to guide them, almost like tell them what to do, and they do it versus like they kind of have to think for themselves almost.
Got it. Okay, so which is the fact that you can anticipate and understand what's going to be happening, and then telling these people, hey, this is likely what's going to happen. Like if this scenario happens, let's do this. If this happens, let's do this. That's impressive.
Yeah, the prime example is what happens when you give rubs.
Oh, okay. What do you mean? Tell me more.
I mean, when you give when you charge back utility from a previous owner that always paid the utilities, like tenants complain like in every possible way, right? And so typically what I do is like I just wait like let's say a month or two, right? I just see who is like the easygoing and the people that will just pay versus who's gonna be like, okay, the hard asses that don't want to pay, right? And then I adjust from there. But that's like prime example of like trying to anticipate what's gonna happen. Just try giving out rubs.
I love that. Okay, last thing. What is your goal for Motiva and what's your plan to get there?
I want to grow it to a bigger AUM, essentially. We're in 3 states now. I want to try to break into Texas and then potentially get more properties and also build teams out there. So we're super vertically integrated in SoCal, not vertically integrated in other states. So I want to try to build out different teams. And kind of, I think the path to get there is, one, I got to get assets there, right? It's like I want to buy properties there and I want to get to know the market super, super well. And then I feel like I know the market well enough here that I can virtually manage and also have a well-established team here. So I can kind of put SoCal in my back pocket and just kind of virtually manage it and then stay more focused on the other states. So definitely, try to get more acquisitions on that side. And then also on the investor side, like if we can bring on partners, partners that not just provide capital, right, but also provide value, right? Those that can, maybe teach me something that I just don't know, right? Or like show me how to do something, right? Like I learned really, really fast as well. And I'm like super happy to hear everybody's thoughts. So definitely want to try to find partners and investors to work together with.
So in the next 10 years, you're hoping that how many assets under, what's your AUM in 10 years?
I hope something in the B's, honestly.
Okay. All right, there we go.
If we don't get there, then something's wrong.
Dude, I think you're not gonna have a problem doing that with where you're at today, being 21 coming up here in the next month, but 20 years old, man, it is incredible. Zihao, thank you for being on here, man. If anyone wants to reach out to you, is there any place where they can connect with you? If there's investors in Texas or brokers in Texas who've got deals for you, or Florida, like where can they reach you?
Yeah, I'm super active on LinkedIn.
Okay.
Also my website, motivaholdings.com.
Perfect. Amazing. Zihao, great talking to you, man.
Thank you so much for having me.
Thank you.
Thank you for listening to this episode. If you enjoyed the podcast, it would mean the world to me if you could rate us 5 stars on YouTube, Spotify, and Apple Podcasts. It really helps us get our name out there and helps us get fantastic people like our guest to share their insights and knowledge with you. Again, my name is Taylor Avakian. I specialize in the sale of apartment buildings in Los Angeles and Southern California, and I look forward to sharing more of these conversations with you. See you in the next one.